It's time to discuss bonds. Boring bonds, stodgy bonds, reliable bonds. So let's get started with Chapter 8, Introduction to Bonds. And we start with a quote that predates the movie Gentlemen Prefer Blondes. Gentlemen Prefer Bonds by Andrew Carnegie, the steel magnate. You might have heard of Carnegie Mellon Institute and Carnegie Hall. Indeed. At the time when he said this, most people didn't own bonds. Most people didn't own stocks. It was gentlemen who owned bonds and stocks. And so Andrew Carnegie thinks that bonds are the better choice for gentlemen. Is he right? Well, it depends, right? Do you want to eat well or do you want to sleep well? Bonds help us sleep well, but there are times, and maybe this is one of them, where people start to have trouble sleeping at night invested in bonds. Let's explore why. What are bonds? Bonds are negotiable, publicly traded, long-term debt securities. There's that word again, securities, which means they are financial investments that can be traded. Whereas the issuer, the entity that has created the bonds, agrees to pay a fixed amount of interest over a specified period of time and to repay a fixed amount of principal at maturity. They're loans, they're IOUs. And so that's why we often call them debt financing, as opposed to stocks, which are equity financing. You're selling a piece of your corporation. With bonds, you are borrowing money. And we know when the bond is created how much money we're going to get because there's a stated interest rate and a principal to be paid back. So that's why we often call them fixed income securities or fixed investments. Look, it's just this is an IOU, right? It's a loan that is issued by corporations. Those are corporate bonds, state and local governments, municipal bonds, munis, and the federal government treasury bonds, the government bonds, the granddaddy of them all. The bond holder, the investor, loans money to the bond issuer because bonds are loans. And investors who buy bonds are loaners, Loaners. Instead of owners, when we invest in stocks, we're part owner. We are buying equity. We are investing in equity. When we invest in bonds, we're playing the part of the bank and we're lending our money with a promise that they will pay interest and pay back the principal. The trust indenture is the contract that sets forth the terms between the issuer and the bondholders. It describes the bondholder's rights and the issuer's obligations, and they appoint a trustee to oversee that these obligations are carried out. And there are commercial banks and trust companies that take on this role, because if you're a bond investor, you want to make sure that the entity, the bank, the corporation, the municipality, the federal government owns up their part of the bargain. And so there are what are called protective covenants, obligations of the bond issuer to keep doing business, keep equipment in good working order, make payments on time. One example is the bonds that Southwestern Community College sold. We borrowed money from the general public, from the investing community, to fix up the campus, and we're tearing down all the beautiful, old, gorgeous buildings and putting up ugly, boxy book buildings that are earning us onion awards from the Orchids and Onions group. But the stadium, we didn't have a bake sale to build that stadium, folks, right? We issued bonds thanks to the voters of the South Bay community. And in the protective covenants was a provision that said, look, you got to use this money to do what you said you're going to do. You got to use to build the performing arts center and and the new Math Science Center and the stadium. You can't use it to have a party or give yourself a raise. And the trustee watches over that to make sure they do what they said. We do what we said we're going to do. Why should you invest in bonds? Well, just like a bank, you're going to receive interest during the life of the bond. Now, bonds generally pay every 6 months. You're used to paying your mortgage and your car loan, credit card every month. No, bonds typically pay every 6 months, although some pay monthly, some pay yearly. But in our class, we'll always remember that they pay every 6 months. And then when the bond is redeemed, the principal is returned. Huh? Yeah, they wait until the bond is matured for the principal to return back. We're used to paying some of the principal and some interest at the same time. Most bonds don't work that way. Some bonds do, but most bonds don't work that way. Now, this third bullet says there's a potential for capital gain or a loss. Huh? If interest rates fall, there is a potential for a capital gain, but there's also potential for capital loss if interest rates rise. This doesn't make any sense. How could a loan's value change? Well, look, we're going to discuss this in detail, and it is by far the most tricky part about bonds. But if you intend to hold on to your bonds until maturity, you don't care about this. You don't care about capital gains or capital losses. Some bonds, municipal bonds, offer tax advantages that we'll discuss. And some bonds can be converted into stocks. That's interesting. Convertible bonds. They're not that exciting. Actually, it sounds exciting, right? Kind of like a convertible car, right? No. They're not. We'll deal with them later on. They're part of the hybrid securities we briefly mentioned at the beginning of the semester, and we'll devote a small chapter to them. But they're really not that important to the vast majority of us. Go to the next slide, please. This thing does some strange things sometimes. Bondholders are first in line for repayment if there is a default on the loan. Who's at the back of the line? Stockholders, right? Now, that's not really true. If there's any taxes due or payroll expenses, they have to get paid first. But typically when a company goes into bankruptcy, the bondholders are standing, waiting. The stockholders are going, no, by the time this carcass is picked over, we're not going to get anything. So bondholders usually get something back, whatever they can claw back from the corporation. In a municipal case, it's a whole different world, but there's not that many municipalities that have gone bankrupt. I don't care what any right-wing nut jobs on the radio are saying. The United States Treasury is not going bankrupt. We have a definite debt problem that we're going to have to deal with. That's going to be painful eventually, but it's not going to go bankrupt. Bond prices are far less volatile than stocks, but bond prices still fluctuate. Bond prices can go down and do go down when interest rates rise. Yeah, we'll discuss this in detail, so just stick with us. But what has the average return over decades been? Well, bondholders throughout the 60s, 70s, and 80s, and then the 90s, 1960s, 70s, 80s, 1990s, and then even into the early 2000s, they expected to get about 4, 5, 6%. Some bonds paid more, some bonds paid less. But lately, since the Great Recession, the global financial crisis, bonds have been paying very little. 2, 3, 4% has been really good. Now, here we are in early 2022. Well, actually not that early, it's April. And interest rates are going up for a variety of reasons. Inflation, where the global economy is being woken up from the induced coma. The supply chain, that was COVID. The supply chain issues are being worked out. And at the same time, we've got a war going on, which might become World War III. So interest rates are going up. And we're going to see that a lot of people are very upset about this because interest rates go up, bond prices go down. But if they have a long-term perspective, this is actually a good thing, assuming the world doesn't end. More about this later. So what can we expect from our bonds? I don't know. Let's say 3 to 6%, 2 to 6%. But we'll see. We'll see what happens. Will they plummet again, as some people are saying, because the global economy is going to completely collapse and the demand for money will collapse? Or will they continue to rise as the global economy continues to sputter along and we don't have World War III? Slide number 6. Bonds versus stocks. I know I laugh, but I'm really frightened. I don't know about you folks. As I told you at the beginning of the semester, economically, I'm really excited about the next 20, 30 years. Politically, I'm terrified because of the rise of authoritarianism around the world, including the United States. When you hear people say, I'd rather be a Russian than a Republican, than a Democrat. I'd rather be a Russian than a Democrat. That's a very scary thing. People praising Putin. Oh boy. Let's get back to bonds and stocks. Slide number 6. Over the long term, stocks have outperformed bonds. Okay, so why invest in bonds? Well, stocks are far more volatile. They carry more risk. There's the I can sleep better at night factor. Bonds offer an element of stability to your portfolio. Some people use the term ballast. If you are a sailor or you were a sailor or you know anything about boats, they will put the heaviest cargo at the bottom of the boat to keep the boat stable. And that's what bonds do. And for some investors, stocks are just too risky. They don't want to deal with the volatility because the volatility is real, and they reason if I can obtain my long-term goals without taking on the risk of being invested in stocks, so be it. The I can sleep better at night factor. Bonds also make good intermediate term investments, 3, 4, 5 years, whereas stocks are definitely long-term, 5, 6, 10, 20 years. And sometimes bonds are just screaming good deals, right? But let me tell you something that I'm really not supposed to tell people. You're not supposed to tell people that stocks have to do better than bonds. But I'm going to tell you, stocks have to do better than bonds. And why is that? Because of the way bonds are paid, right? If they're corporate bonds, the corporations have to make earnings to pay the interest payments and pay back the principal. If the economy has fallen down and stayed down, the stock market, the canary in the coal mine, it's already been destroyed, right? But eventually the bonds are going to start to fail, right? Because the corporations won't be able to pay the interest payments, pay the principal payments. And the same thing is true for the government. The municipalities, how do they pay their interest payments? Through taxes. If corporations and individuals are not earning money, they're not paying taxes, and so the municipalities and eventually the federal government are going to be in deep kimchi. So failure is not an option. It has to work. And so that's why you have to get up in the morning and get your pants on and get to work and produce the goods and services that sounds like an advertisement, but it's true. We're always blaming everyone else, but the truth is it's us. It's up to us to make this economy work. And I know I sound like an advertisement from a public service announcement, but it's the truth. And so I have firm belief that stocks are going to do better than bonds over the long term, assuming we don't blow ourselves up, die in our own waste. You've heard this before. I don't know if this is helpful, folks, because, sports doesn't always translate well. But I like to think of stocks like baseball and bonds like football. Now, what am I talking about? The baseball diamond goes on forever, right? The foul lines are what's the word? I can't think of the word, but asymmetrical or whatever, and they go off into infinity. So there's no end to how far you can hit that ball. Obviously there is, but that's the way stocks are open-ended. The economy can continue to grow. More people can come out of poverty around the world. Whereas football is just in this little quadratic, this little rectangle, and if you go out of bounds, that's it. You can't come back in, and so if that helps, great. If not, oh well, my apologies. But I'm very, very optimistic economically. I like stocks. Okay, let's get going. Slide number 7. What are the risks? Wait a minute. You told me they weren't as risky as stocks, and I'm not lying. The bonds are not as risky as stocks, but there are still risks. The interest rate risk. When bond interest rates fall, bond prices rise, and vice versa. As I said, we're going to go over this in a bit, so just stick with us. If you intend to sell the bonds in the future, a rise in interest rates can translate into capital losses. But if you have no intentions of selling your bonds, don't worry about it. It doesn't affect you. Purchasing power is the risk that your purchasing power will fall if inflation outstrips your return from bonds. And bond investors hate inflation, right? That's why if inflation rises its ugly head, which it's doing right now, people want higher interest rates. Yeah, I want a higher interest rate. And then there's always the default risk, the business risk, the financial risk. This is the risk that the bond issuer will default on interest payments or principal payments. It's much less a risk with municipalities and treasuries, although some munis have gone belly up in the past, but we know that some companies are going to go belly up. It's part of capitalism. So that's something we need to concern ourselves with, and we'll discuss in our next presentation the credit ratings that bonds receive. Okay, what about liquidity? Well, stocks are very liquid, right? They're buying and selling the stocks every day. It can be a problem with bonds. And why is that? Well, because people tend to just hold on to their bonds. They don't trade them like they do stocks, although some people do. So the liquidity risk is the risk that there may not be sufficient buyers when and if an investor wants to sell their bonds. But as we said, most people hang on to their bonds and for interest. It's less of a problem with treasuries and munis, but it can be a big problem with thinly traded bonds. But just as we said, most people just don't trade their bonds. Now, there's another risk called the call risk or the prepayment risk, and we're just going to discuss this call feature in a few slides. This is a risk that a bond will be called away from us before its scheduled maturity date. Think about it, folks. If you have a home mortgage at 6% now, you can run down to your mortgage company. Please, they're dying because interest rates have gone up a little bit, and so they're looking for help. They're looking for business, and say, "I want to refinance my mortgage at 4%." Well, this is the same thing that can happen to bond investors. The bond issuer, the corporation, the municipality, the treasury has never done this, but doesn't mean they won't do it in the future, can call away your bond. They can pay you back prematurely, and then they refinance at a lower interest rate. Some bonds are non-callable. Treasuries have always been non-callable, and some other companies and municipalities issue non-callable bonds. And certainly non-callable bonds are more desirable for investors, but they typically pay less. Risk versus return. The coupon rate. What a silly name. The coupon rate. That's the nominal rate, the nominal yield, the coupon yield. That's the feature of the bond that defines the amount of the annual interest income. As we said, the interest is usually paid every 6 months. That's what we're going to do in this class. But there are some bonds that pay every month, quarterly, once a year. Where did the term coupon rate come from? Well, dear students, it's interesting. Interesting story. It came from the fact that bonds used to have coupons attached to them. Yeah, they did. When the interest was due, an investor was required to clip the coupon, put it in an envelope, send it off to the corporation or municipality, and the issuer would then turn around and write a check back to the bondholder. No. It's none of the. They're all gone, folks. They are now being traded like Beanie Babies on eBay, right? But just you can just look up photos of them. But to this day, it's still in the language. Earning interest from a bond is often called clipping the coupon, even though now virtually all transactions are done electronically. So go look at the images on the Infernal Net, and you'll see these pictures of bonds. Now they're not valid. They're they're all defunct bonds, but they have these coupons attached to them that you would cut out and send in, and they'd send you a check. And why? Well, that made it very easy for you to sell your bond. All you had to do was sign the bond over to somebody else, either through a broker or just find somebody who wants to buy your bond. And then they send in the coupons, and you see, change the name and the address, and the check goes to a different person. But it's all electronic now, so just a bit of trivia. Slide number 10. What's the principal? The principal is the amount of capital that must be paid at maturity. That's the amount of the loan. Now, we typically refer to it as par value, face value. Most bonds are denominated in $1,000 increments. There are some that are 5,000 and 10,000, but look, in this class, just to make life easy, we will always use a $1,000 increment. So this makes it easy for you to understand how much interest you're going to get every year. Putting the coupon rate and the principal together tells how much interest you will receive each year. For example, a coupon rate of 7%, a principal of $1,000, gives us $70 of interest each year. So if it's a 6%, it's $60. If it's a 3%, it's $30. Now, let me tell you, they actually pay every 6 months, so you have to divide that in two. So you get $70 a year, but you'll get $35 after 6 months and then another $35. And since almost all bonds are denominated in $1,000 increments, knowing the coupon rate gives you the amount of interest. Therefore, normally bond investors simply refer to their bonds by the coupon rate and maturity. So I bought a 7% 30-year bond. Are you with me? 6%, $60, 7%, $70, 99%, $90. Watch out, 1% is at $10, 10% is $100. Some people get tripped up on that. Some other characteristics. The maturity date. The maturity date is the date on which the bond matures and the principal must be repaid. And this is one of the few bond jokes you'll ever hear. What's the difference between a man and a bond? Well, the bond eventually matures. Yes. Finance jokes. There's not too many of them, and they're not that good, but I like that one. Most bonds are term bonds. They mature all at once. For example, a company will issue 20-year bonds that all mature in 20 years on the same date. So, you see, we're used to a loan where we pay some principal and some interest. No, most bonds just pay the interest, and then bingo, at the end of the 10 or 20, 30 years, they have to come up with the cash. They might roll over and start a whole new bond issue, or they might have been accumulating that money in anticipation of paying off the bonds. A less typical bond are serial bonds. They have a series of maturity dates. For example, a company may issue series of 20-year bonds with 20 maturity dates. So every year for the next 20 years, some of those bonds will mature. Now, usually you know when your bond's going to mature. It'll tell you. But sometimes they do it by a lottery, which I've never seen. I've read that. I've never seen that. That's a little strange. But usually it'll tell you, this is a series of bonds. These bonds mature in 5 years, these 10 years, these 20 years, and that's how they pay them off. Now, bonds versus notes. Technically, there's a difference between a bond and a note. A note matures in 2 to 10 years. Bonds mature in 10 or more years, 20, 30, 50 years. Some bonds never mature. Those are called perpetuities. I love that word because you get to spit on your friend. I just bought a perpetuity bond. But in practice, most investors, your humble instructor included, doesn't bother with the difference between a 10-year treasury note and a 10-year treasury bond. They're all bonds to me. So you decide whether you want to be, oh, excuse me, that's not the 5-year treasury bond, that's a 5-year treasury note. That's all I have to say. Slide 13. Let's get back to the call provision. The call provision is that provision that specifies whether and under what circumstances the issuer can retire, prepay the bond prior to the maturity date. So as the example we gave, if interest rates drop, just as a homeowner would want to refinance their mortgage, a bond issuer would want to refinance their bond loans. The issuer calls in the bonds. Here, bonds, come here, bonds. Now, obviously, you get your money back, but this means you're probably going to have to go find another bond that's going to pay you less because interest rates have dropped. All their factors being equal, and they never are, investors would prefer non-callable bonds to callable bonds. And you're going to see a presentation with Ford bonds. You're going to see that Ford made some really stupid decisions back probably in the late 1980s when interest rates were really high and made these non-callable bonds paying 7.7% and 9.98%. And they have to continue to pay these until the bond matures. They can't call them away. What a bad deal that was for Ford. Great deal for the bondholders. Great deal for the bondholders. So there are three types of call provisions. Freely callable, which can be retired at any time. Non-callable, which means, sorry, you have to keep paying me the interest as long as I hold the bond until it matures. And then what is more typical is the deferred call, the call protection period, the call deferment period. They say, look, we won't call them for the next 5 years, the next 10 years. All right, so you get to get this interest rate at least for 5 or 10 years. And if you go on the presentation for the Poway bonds, you'll see that they had a deferred call period, and the other muni bond that was advertised with the Poway School District bond. Most corporate and municipal bonds are freely callable or typically have a deferred call period. Treasuries have always been non-callable. That doesn't mean that the Treasury in the future won't issue callable bonds, but they never have. Which is the most desirable? Obviously, non-callable. Least desirable, freely callable. And deferred call is somewhere in the middle. If your bond is callable, often what they will do is they will add a call premium. That's the amount that is added to the bond's par value and paid to investors when a bond is retired prematurely. So let's say they have an $85 call premium. You can think of it like the prepayment penalty on a home mortgage. Most home mortgages won't have a prepayment penalty, but some of them will. And so they'll say, look, you want to pay us back, you have to pay us more than what you owe us. And the same thing is true for bonds. If there's a call premium, then the call price will be equal to the par value plus the premium. Now remember, in our class, everything's going to be $1,000 par. So if it's an $85 premium, it'll be $1,085 that they have to pay us to pull the bond away from us, to call the bond away from us. If there's no call premium, the bond is said to be callable at par. In other words, if they give you $1,000, you have to give them the bond back. Make sense? I think so. Go over it again if it doesn't. Think of it like a prepayment penalty on a loan. Now, slide 16. All right, everybody stretch. I know, because now you got to get our little brains stretched out here, because this is by far the most misunderstood feature about bonds is their inverse relationship with interest rates. I like to think of the seesaw. That keeps me out of trouble. And by the way, this gives people who've been in the industry for decades fits. And you always zig when you should have zagged there. Think of the seesaw. When interest rates fall, bond prices rise. When interest rates rise, bond prices fall. It's an inverse relationship. Kind of like the relationship of truck tires on pickups and the driver's IQ. The bigger the tires, the smaller the IQ. I told you we're going to insult everybody by the end of the semester. Okay, so remember the seesaw. Remember the sube y baja, because that really is a very good analogy, a very good image to have in your head when you discuss this. Premium bonds are bonds with a market value greater than the par value, And this occurs when prevailing interest rates drop below the coupon rate. A discount bond is a bond with a market value lower than the par value. It's below $1,000. A premium bond is above $1,000. This occurs when prevailing interest rates are greater than the coupon rate. But a discount bond can also occur when and if the investment community believes that the bond issuer is in danger of defaulting on interest payments or principal payments. So remember, these are traded, they're securities. So if people believe that the bond is in danger of not being paid, the corporation or the municipality is not going to be able to make their payments, they're going to sell that bond no matter what, and the price is going to start dropping. So that's another time when there could be a discount bond. So let's ask ourselves, wait a minute, why would a bond sell at a premium or a discount to its par value? If the loan is for $1,000, the bond would always sell for $1,000, right? Doesn't that? That's what intuitively people think. At least that's what I thought when I came to the investment community. And then no, it doesn't work that way. Since the interest rate of your bond doesn't change, remember that's why we call them fixed income securities. The price of the bond changes to reflect the change in the prevailing interest rates within the financial industry. Remember the image of the seesaw. Keep this in mind. Now, hopefully over the next couple of slides, it's going to make a whole lot of sense now. I know it's a little fuzzy. Why would that happen? Well, watch. Watch the example. Slide 19. If we have a bond paying 10%, which means we got it back in the 1980s, the bond's face value is $1,000. So we're getting $100. Well, actually $50 twice a year, because 10% of $1,000 is $100. Now let's say interest rates fall to 8%. New bonds are paying $80. An investor would have to find a bond that, they don't make bonds at $1,250, but they would have to pay $1,250 to get that same $100 worth of interest. So are you going to sell your $1,000 bond for $1,000 knowing that people are paying $1,000 to only get $80 of interest when your bond is paying $100 of interest? No. You would not sell it at $1,000. You would demand a premium. So the result of interest rates falling is now your bond is worth more than it was. If you were to sell it, which you don't have to do, you can hang on to it. But if you were to sell it, you would now have a capital gain. The bond could be sold at a high premium. You see how the interest rate doesn't change on the bond, it's fixed. The price changes as interest rates change in the investment community. Starting to make sense? Listen to it again, rewind it, and then continue, because now we're going to do the other side. A discount bond. Let's say we have that same bond paying 10%, which means we're getting $100 a year, $50 twice a year. But now interest rates rise to 12%. Now investors are getting $120 on a $1,000 bond. Are they going to give you $1,000 for your bond that's only giving them $100? No. They're going to demand a discount, because if there were a bond that was paying $833, that was priced at $833, they would be getting that $100 of interest at 12%. So they're not going to pay you $1,000 for that bond, for your bond, because it's only paying $100. New bonds at $1,000 are paying $120. So the result is your bond is now worth less than it was when you bought it. You would have a capital loss if you were to sell it. Now, again, you don't have to sell it. Nobody's putting a gun to your head. But if you were to sell it, investors would not pay you the $1,000 par value. They would pay you a discount. They would demand a discount, and a fairly large discount if it were a 2% rise in interest rates. And it also is important how long till the bond matures. Slide 21. The amount of the premium or discount is not only related to the amount of the fall or rise of interest rates. In general, the greater the fall or rise in interest rates, the greater the premium or discount. The maturity date is also very important. Why? Think about the seesaw. I don't know if you remember, but I used to love playing on the seesaw, and I would play in here. I would jump in the middle when my buddies were on the either end, and I would go back and forth. Now, if you're in the middle here, you don't move up and down a whole lot. If you're at the ends, and then you move way up and then way down. So you see, that's why when we were discussing mutual funds, bond mutual funds, we said long-term bond mutual funds exhibit more risk, more price volatility than short-term, and of course intermediate term or somewhere in the middle. So the farther out you are on the seesaw, the more it's going to rise if interest rates fall and fall if interest rates rise. So just like the seesaw, the farther out you are, the greater the rise or fall. This is why long-term bonds, and we discussed long-term bond mutual funds, are riskier than short-term bonds. In general, the longer the maturity, the greater the premium or discount. So you have a greater opportunity for prices to rise if interest rates fall, but you also have a greater opportunity for prices to fall if interest rates rise. So keep that seesaw image in your head whenever you have to discuss the bond price and interest rate behavior. Okay, next slide. Let's go. Here, this is a graphic that I hope kind of shows what happens. This is the, really, that zero should be over here. I got to fix that. So here we're time to zero because this is time zero. The time to maturity. Maturity is at zero. So this is a mistake. I got to fix that. I'll fix it by the time you see this, I hope, because I'm not very good with graphics. But you see what happens? The farther you are out until it matures, say it's got 30 years to mature, then the bond prices are much higher if interest rates have fallen and much lower if interest rates have risen. But as we get closer and closer and closer to maturity, the bond prices get closer and closer and closer to the par value, which is, in this class, is always $1,000. Although we know that there's some $5,000 and $10,000 bonds. So does this graph look good? I got to fix it. But that's the idea. And this is you don't know exactly how the curve is going to look, but it's typical. This is typical of what the curve will look for the premium bond prices and the discount bond prices. Got it? Okay, I hope so. In general, long-term bonds exhibit greater price volatility and a greater opportunity for capital gain or loss. Intermediate-term, short-term bonds exhibit lesser price volatility and a lesser opportunity for capital gain or loss. Bonds very close to maturity act very similarly to the short-term investments we discussed back in chapter 1, such as money market or treasury bills. You see, because if the thing is going to mature in 3 months or 6 months, you see, it becomes like a short-term investment. If you intend to keep your bonds until maturity, then you're not concerned about the price volatility. You will always receive the par value of the bond, except in the rare case of a bond default, which we don't want to discuss at this time, but it happens. So now, I know that inverse relationship is tricky. Go back over, listen to it, watch it, read it again, and think of the seesaw. Think of that seesaw. And I think it helps me a lot. Before we end, let's take a look at a slide that we saw way back in chapter 3 when we were discussing stocks that shows the yield on stocks with dividends and the yield on bonds with interest payments. Now, what happened here? We started in 1960, about the same, bonds paying a little bit more than stocks. But then inflation got out of hand in the 1970s. That was the decade when the baby boom generation came of age and all went out and had to get jobs and dishwashers and cars and houses and shoes. And it was a very difficult time for the economy. And we had other exogenous events like Watergate and Vietnam and disco. But as we said back in chapter 3, President Jimmy Carter, yes, we had a president named Jimmy, said to the newly appointed Federal Reserve Chairman, Paul Volcker, Mr. Volcker, you've got to do something about inflation. And he said, Mr. President, we can raise interest rates dramatically, break the back of inflation, but it might cost you your 1980 election. And to Mr. Carter's credit, he said, that's not your problem. Your problem is to get the inflation under hand. It's my problem. And he did lose the election. It wasn't only that. It was also the Iran-Contra affair, the Iran hostage affair. That was a real mess for Carter. So go back and you history buffs and look at it. So what happened? He was right. He broke the back of inflation, also created the worst recession since the Great Depression, which was not as worse as the Great Recession in 2008-9, but still pretty bad. And then we see interest rates falling and falling and falling and falling. And we see the dividend yield falling as stocks went in two directions, 1980 to 2000, up and way, way, way up. And we saw the stock yield hit 1% at the peak of the stock bubble, March of 2000. But interest rates kept falling and falling until finally 2008, we saw that really weird situation where bond yields went below stock yields. That was a great time to buy stocks, folks. But of course, everybody was worried about the end of the world. And then we see that bond yields have continued to fall. Now, just recently, with a strong economy coming out of the self-induced coma of COVID and war going on in Eastern Europe, we see inflation rising, and we're seeing bond rates are going up. Bond interest rates are going up. So for those people who are worried about, having to sell their bonds, they believe that their bonds are going to fall, and that's something that's going to happen. But as we're going to discuss throughout our discussion of bonds, keep a long-term perspective. Rising interest rates are cool. They're great if you have a long-term perspective, because that means you're going to get more interest. Yippee. When we come back, we will go through the various types of bonds, and we'll do our best to run through them quickly because it's a little dry. I apologize. It's bonds. They're boring. They're stodgy. But they're reliable. See you in our next presentation, where we'll discuss the different types of bonds and then bond ratings and quotes, bond quotes.